So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, welcome back to The Daily Call. My name is Kirk here again at Option Alpha. And on today's Daily Call, I want to talk about the difference between buy to open and sell to open for options trading. Now, this one is one that I think a lot of people get slipped up on, and it's just a very subtle difference, but it's kind of confusing because when you get started in options trading, it's obviously another dimension, if you will. With stock trading, it's very easy to understand. You buy stock and then you sell it, hopefully at a higher price. And then when most people start transitioning, they start realizing that, with stock trading, you can actually sell stock at a higher price and buy it back at a lower price. And that's called short selling a stock or short trading. And the same thing actually happens with option contracts. So when you buy to open, you are basically outlaying money. You're buying an option contract to initiate a position or start a position. Now, the catch to that is eventually you have to sell to close, right? If you buy to open, the only way that you can get your money back or to complete the trade is to sell back your option contract to close the position and get whatever value is left in it. In this case, if you're buying to open initially, you're usually doing some sort of a debit trade. So that doesn't have to be necessarily a single long contract. You could buy a debit spread where you do a combination, but you're still outlaying money to initiate the position. And so again, the only way that you get money back is you hopefully see that position increase in value so that you can sell to close. Now, the difference between that and the other example, which is sell to open, is that in the case of sell to open, you are actually selling a contract or a spread that you have to buy back to close later on to complete the transaction. And I know it's a little bit confusing when you get started because how can you sell something you own? Well, you basically, in very simple terms, you have an obligation to buy back that contract. So you openly sell that contract to somebody else with the understanding that you will buy that contract back in the future or close the position and complete the trade. So when you sell to open in options trading, you are taking in a credit, and that credit is usually the most amount of money that you can possibly make on the trade. So if we sell to open, say a straddle, and we take in an $800 credit, we really can't make any more than $800. Our goal at that point is then to buy back that straddle at a future date or when implied volatility drops or when time decay starts working its magic, to buy back that straddle and complete the transaction for less than the $800 credit that we took in. This is actually no different than insurance. Insurance is very much the same way. The insurance company sells you insurance. They sell you a policy on a house, right? And they promise, it's basically an obligation or a promise, that if something bad happens to the house, that they will pay. They will collect, or they will, outlay the money to repair the house or fix the house or whatever the case is. Same thing happens in options trading. We sell a contract. We're basically selling an obligation that says that we will buy the stock or, complete the transaction in the future. Now, just like an insurance company, if they sell you insurance on your house and nothing bad happens, well, they complete that contract at the end of the year and they resell you insurance again. And so they sell it to you again the next year and the next year and the next year and the next year, continuing to collect premium until, or if nothing ever happens, to your house, then they collect all this premium. Same thing happens in options trading. We continue to sell premium. If nothing happens during that month and our short strikes don't ever get hit, we continue to hold that premium and keep it, or we buy the contract back later at a lower price and complete the trade. So again, it's a very subtle difference, but I think once you start really looking at who's involved and what party you're on, you realize that there's a buy to open and a sell to open for every transaction. Somebody has to be a buyer, somebody has to be a seller for the two parties to meet up and complete the transaction. So hopefully that helps out. We'll have more of these kind of technical questions as we keep going through these podcasts. But if you guys have any questions, please let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.